Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform 2.0 to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services Leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're at Westminster Studios in St. Louis, Missouri, where I'm excited to have a fully vaccinated Calum Dewar back on the podcast. Calum is an international tax partner in PwC's Washington National Tax Services Office and the leader of our integrated global structuring practice, heading our outbound, inbound, and value chain transformation teams. Calum spent the first 20 plus years of his career working in the UK. Calum, welcome back to the podcast.
Good to be here.
Nice to see you in person. It's been a while. So Calum, before we dive into BEPS 2.0, which I'm very excited to talk to you about, I had a kind of non-related question that I wanted to get a reaction. I know that you were born in Scotland, right? But you spent a considerable part of your life in London, England, and you've done a tremendous job educating me the difference between being British and being English, okay? But I wanted to get your thoughts about England making it to the final of the UEFA Cup and then losing in penalty kicks to Italy. What was your reaction to that?
Forza Italia. I'm at risk of upsetting any English people watching, but I'm Scottish. There are two teams, Scotland and anybody who's playing England.
So the reason I mentioned that, I was hoping you were going to say that, because as a St. Louisan, we have a very similar philosophy in that our favorite teams are the Cardinals and whoever's playing the Chicago Cubs. Right. So I appreciated that you were one of the biggest Italian fans during that UEFA Cup final.
For one match only.
For one match only. I understand. All right, so it's been a while since we've talked about the OECD and the BEPS 2.0 initiative. A lot has happened since we've had Will and others on the podcast to talk about these latest developments. Maybe for those that have recently just started tuning into the podcast and don't have a lot of background, can you just spend a few minutes reminding our listeners, first of all, what is the OECD? What role do they play in developing tax policy? And then we can talk a little bit of an overview about Pillars 1 and Pillar 2.
So the OECD largely play a sort of guidance overview role. It's a forum for the nations that are members of the OECD to come together and agree taxing policy. And historically, the OECD have been pretty heavily involved in two key areas: treaties and treaty policy and transfer pricing. Now, all that changed way back in 2014, 2015, when the OECD undertook BEPS version 1, which covered obviously the 15 working parties and all the papers that came out then, hybrids, et cetera, And then they've rolled that forward into this, what has been called BEPS 2.0. I know that Will Morris, for example, always gets very angry when it's called BEPS 2.0. It's a different process. It's talking about reallocation of taxing rights and a minimum tax regime as well. So it's much more holistic than the targeted measures of the first version of BEPS. But what's important to remember is the OECD doesn't have executive authority to do anything. It's a body which operates through consensus. Reports that are issued are consensus reports, or, as we see more recently, reports that don't get to consensus and explain where the differences of opinions are if they can't get to consensus. And then those reports, it's up to the members of the OECD, and now expanded obviously to include the inclusive framework, which is a much, much bigger body of countries than the OECD, to go away and take what's been recommended and turn it into actionable items, execute the proposals in legislation.
Yeah, there seems to be a number of misconceptions kind of out there about how law becomes law in respective jurisdictions, right? So to your point that the OECD makes these recommendations, but each respective jurisdiction has to actually go through what their legislative or regulatory process.
Right.
We've also have seen this with some of the OECD reports, and we'll unpack this throughout the course of the podcast, but there's almost been some presumptions by the OECD that the Treasury Department, and specifically Janet Yellen, could change law in the U.S. and so far as, for example, a GILTI, by country, and we all know that needs to be done by Congress.
Yeah, I mean, the Green Book is, as far as the OECD appears to be concerned, is written legislation that just needs a process to go through enactment, which obviously is not the case.
Yeah, so it's very similar to the same reports that the OECD puts out. These are, documents on tax policy, not necessarily actual law.
And I think that's going to cause some consternation over the next few months, I suspect. We can get into that, obviously.
Yeah. So remind people, you talked about Pillar 1, reallocation of taxing rights, and Pillar 2, sort of minimum tax type concept. Tell us a little bit about, just remind our listeners kind of what Pillars 1 and Pillar 2 are.
So Pillar 1 in its genesis was largely focused on the digital companies, the companies that were capable of earning revenue, significant revenues from jurisdictions without a physical presence, and it was very focused on digital tech companies. That's moved on a bit, and we can come back to why that is. But what Pillar 1 is largely focused at is saying there are some very profitable companies out there that earn profits largely by reference to the current transfer pricing model as to where the IP is located, and probably don't pay much tax or as much tax as people would like them to in the jurisdictions in which they earn the money from, the market jurisdictions. And so, this started off as Pillar 1 as a notional reallocation of profit along with a notional taxing nexus standard, and that's largely where it's gone, except it's moved away from purely focused on digital companies and merely now focused on very profitable, very big revenue companies, with a formula to say that of those multinationals that qualify under the filters, and the filters are significant. You're talking about, at least for the first 7 years, $20 billion of revenue a year in order to be in the regime, which obviously is a huge number. And then even if you've got $20 billion of revenue, if your profit margin isn't more than 10%, you're not in the regime either. So within those two filters, that narrows it down to a relatively small number of companies. There seems to be ongoing debate as to how many companies they are, but a relatively small number of companies, with then the notion that some element of their excess profit over the 10% profit margin will be reallocated away from the IP centers to the market jurisdictions.
Yeah, and this is a fundamental change to how we consider where taxing rights develop. Right? We're, when I was in law school, we learned what a permanent establishment was, and we've got 100 years of precedence, and so now it doesn't really matter where you have that physical location or that nexus. This is where are your customers or where are your users.
Well, it's an addition to those rules, so it's not seeking to replace those rules. It's a regime that sits on top, both with regarding to creating taxing rights like a notional permanent establishment provision, and also what an arm's length profit should be. There is no attempt in the OECD report to argue that this is applying traditional transfer pricing arm's length standards. This is a reallocation on top of those arm's length standards.
And so what about Pillar 2? And we're going to dive a little deeper into each of these.
Yeah,
what
so
about Pillar 2?
Pillar 2 is being put as the sort of second half of this, which is how to ensure there is no longer a race to the bottom on tax rates around the world. The perception has been that countries have been using tax regimes to encourage investment in their jurisdictions, often that investment not necessarily matched with all the requisite substance or whatever it is, and that countries have used rate to attract investment. And the feeling has been, therefore, that there needs to be some minimum tax regimes to deal with that race to the bottom. Now, part of this was provoked a little bit by the US introducing GILTI, which is effectively a minimum tax regime top-up. But the OECD Pillar 2 proposal is different from GILTI, has some similarities, but is different. And what the OECD proposal, as it currently stands, is that there are some rules that have a priority order. And the base rules are that every jurisdiction should implement an income inclusion regime. And what an income inclusion regime does is say, look, if I'm the parent company of a multinational group and I have this regime implemented, I will apply a top-up tax on any companies that operate, subsidiaries of mine that operate in other jurisdictions that have a tax rate lower than the minimum tax rate, which, as it stands at the moment, is proposed to be 15%.
And in that respect, it's similar to GILTI.
It is, except it's by jurisdiction and it's based on accounting profits, not tax profits, and there's a whole bunch of differences that we don't necessarily want to get into. So that's the priority rule, is an income inclusion regime. Because the OECD is aware that maybe not everyone will implement that regime, they've provided a sort of backup regime, which is what's called the undertax payment rule, UTPR, which says, look, if I'm a country that is making deductible payments and they are not being paid to related parties, and they're not subject to a tax that is a minimum tax of 15% and are not included in an income inclusion regime, so in other words, they haven't had the top-up tax imposed on them and they're not suffering tax at least at 15%, then the jurisdiction making the payment, in theory, can then deny deductions to get to a minimum tax rate of 15%. Now, that secondary rule is a secondary rule, and clearly the ambition, how likely this is, the ambition is that rule would never apply because everyone would implement an income inclusion regime, in which case the undertax payment rule gets turned off. The reality is it's going to have relevance in various situations where income inclusion regimes are not implemented or are not implemented at the same time,
right,
or whatever.
You can imagine timing becoming an issue.
Well, time, and even, the problem the OECD will always face, and they faced it the first time round. I mean, you and I have worked on clients where we're trying to work through the hybrid rules, and every country seems to have somehow managed to take a consensus set of legislation and write rules that are slightly different in some regards, sometimes better, sometimes worse. But the notion that everyone's going to implement exactly the same rule, I think, is a dream that may not come to pass. So we're always going to have those differences. There is another rule in the Pillar 2, which is the subject to tax rule, but that's relatively narrowly likely to have any impact. It deals with payments that are covered by a treaty where one of the treaty partners has introduced a regime that's preferential after the signing of the treaty.
Right.
So it's a relatively narrow field, I think.
Yeah, so we'll put that one to the side.
Yeah.
So it's early August 2021.
Yeah.
Just to give some context for our listeners, depending when they're listening to this. Where are we in the OECD's process related to BEPS 2.0? So it's been fascinating to me. I mean, I get questions, Calum, from my mom now about this, a retired school educator, right? Because it's in the news now.
Right.
I mean, it's remarkable to me that international tax is such in the news that my mom is asking me questions about this, because when we had the G7 meetings and the G20 meetings, and then the OECD is trying to get to some consensus. Remind me even kind of where we are. It's easy to get lost in all of this.
So where we are is that the G7 reached, quotes unquote, a political agreement, and the G20 endorsed that political agreement, which broadly said that, the work done to date has largely reached a point where everyone agrees it should move forward to go through the proper design elements. The inclusive framework, which is 139 countries, I believe, were asked to also sign up to that consensus political agreement. About 132 countries did sign up. There were some countries that did not sign up at that point. They didn't say they wouldn't sign up. They weren't saying we don't agree. They're just saying we're not ready to sign up now in the current framework. So that's all happened. And that's a political agreement. And political agreements, if you're deeply cynical, are maybe not even worth the paper they're written on, because obviously then it has to go away and be designed. The next phase is by October of this year, they're supposed to have fleshed out those design elements. There's an awful lot of fleshing out to be done in order to get to, really well-defined mechanics. I mean, things like Pillar 1, there's been no discussion yet as to how you reallocate the profits, what's the mechanism for reallocating the profits. There are some significant technical issues within that framework. Pillar 2 has many of the same issues as well. So huge amount to do in order to get to, implementable consensus recommendations. And I don't think even October 21 is really targeted at that. I think what October 21 is targeted at is a framework for then, during 2022, the OECD to work up, detailed proposals to then be considered by countries to be implemented.
Yeah, and that proposed implementation date, is that January 1, 2023?
They don't really have a date, because obviously it's left then to the countries to go away and implement. I mean, the OECD never imposed a timetable. What will normally happen is they'll have a recommendation for when countries should do this by, and then countries will go away and consider their own political ramifications, their own government position. Some of those governments are minority governments. A lot of European jurisdictions run off minority governments. It's not so easy to get things through.
Right.
You've then got blocks of countries like the EU, where the proposals have to then somehow be conformed to EU law and make sure that there's no discrimination within the EU on those laws, and to implement that. So normally the EU would do that through a directive. That requires unanimity. Interesting to note that at least two of the countries that did not sign up to the inclusive framework are both in the EU.
Right. We're gonna talk about that.
So they've got to get those countries on board before they can get to implementation.
So I did want to get your reaction to a quote, because one of the things that I like to do in my spare time is listen to other tax podcasts. Kind of checking out the competition out there. And the OECD has its own podcast, and Pascal Saint-Amand, who is the head of tax policy, I don't have his exact title, the head of tax policy for the OECD, said this quote, and this was just this past week, again, in August 2021, that, quote, "The next step is finalizing the deal in October. There is not much to do, just a few numbers to firm up," close quote.
Pascal, has a position. He's the face of the OECD. He wants to be pushing the process forward. I think at some level you could say he's right. I mean, they need to agree the minimum tax rate. That is a number they need to agree. They need on Pillar 1 to agree the thresholds to get into it and how much of the profit should be reallocated, and that is a number to be agreed. The problem is, behind those numbers is a huge amount of detailed rules that will be required to make it operational.
Right.
And so I think that's yes, at one level, if all you need to do is agree the principles of the numbers and where the thresholds are, it's probably true, but that isn't where the OECD needs to get to pass this over as an implementable set of proposals.
Got it. So let's spend a little time talking about some of the challenges with Pillar 1. You had already mentioned one as far as how to reallocate profits. One of our partners recently published a paper, Carter K. Singh, and we'll include a link in the show notes for those that are interested, specific to what companies may be subject to Pillar 1. And you had talked a little bit earlier that there are some income issues or there's some income thresholds to meet as well as margin thresholds. And I think based on his math, it was something like 60-something% of those companies were U.S. multinationals. Yeah. But maybe we start there with just the challenges of who does this apply to? I know there's been some questions about whether this should apply to the financial services industry, and talk about broadly some of the challenges with respect to the scope of Pillar 1.
So there are still discussions to be had on carve-outs. Where it sits currently on carve-outs is it appears that extractive industries are carved out, largely because they're largely taxed where they extract from anyway.
Right.
So that they really don't have no non-nexus. I mean, you can't hide a hole.
Right.
It's just difficult to do.
Right.
And they have all sorts of incremental taxes that are imposed. So I think that was a fairly early, call out. Financial services was in doubt, maybe still be in doubt. We'll have to see where it goes to. But the UK, for example, lobbied quite hard for financial services to be excluded. The UK economy is largely a financial service-based economy. You could draw from that conclusion what you want. But at the moment, it appears that financial services might be carved out. There are then challenges that they still have to work through around, if your filter is going to be 10% profit margin and $20 billion of revenue, then you do have companies that have segments, some of which would fall within the high profit margin criteria, some which wouldn't. And so there is ongoing debate around segmentation and how to deal with segmentation. Because if you take a whole multinational group together, it may well be that some would argue one part of that group should be subject to these rules and is being sort of covered up by a very low profit margin business that's also owned by that group. And in conglomerates or even in non-conglomerate businesses, there can be different profit margin businesses.
That's very common.
Just the notion. So there's the segmentation point. There is the calculation of the reallocation. Who is going to give to whom, and what is the mechanism for giving it to whom? Is it going to be, a notional transfer pricing adjustment? Is that going to be taken into account when you start calculating the Pillar 2 numbers? Is Pillar 1 going to come first and then you look at Pillar 2 afterwards? A whole stream of issues around that, along with, the accounting profit conundrums and how you deal with accounts and things like that. So Pillar 1 has a whole series of issues that need to be resolved just in that. And how you're actually going to implement that. And what happens if, 60% of the world goes forward with Pillar 1, but one of the countries that doesn't is one that would have to reallocate profit? Then how are you going to force a reallocation of profit? Those sort of issues need to be resolved.
Well, and that's one of the questions that I have is just thinking about the U.S., right? And so I think it's Janet Yellen or at least the Biden administration has come out and said that they think that at least based on the current framework, that the U.S. could be relatively neutral on, given the size of our, the customer, the user base that sits in here, that sits in the U.S. compared to, those U.S. multinationals that may have profits allocated outside the U.S. Based at least on some of the data that we've seen and the analysis again by Carter Kay, that seems difficult to square to me, that the U.S. wouldn't become a significant loser without doing those economic analysis. But the other thing that is related to that is that there appears to be some sort of presumption that the U.S. can actually implement this rule through the form of legislation through Congress. So what is your reaction to that, and as we're thinking about from a U.S. policy perspective?
Well, so I think the numbers we have to work through, and once they've actually designed the filters and the profit margins, etc., you might get closer to that. I mean, there is a degree of truth that the U.S. remains the biggest consumer market in the world. So if you are reallocating profit based on the size of the market and the contribution of the market, then you might expect the US to pick up some amounts. But if people like Carter Kay and other people who've done reports on this are right, and 66% of the companies that are going to be affected are US multinationals, then it seems to me it's unlikely to be a zero-sum game for the US, I would think. Now, obviously, Janet Yellen must have sources of data. I'm sure she has, lots of power to get data. So we'll have to wait and see. But it does seem to me to be slightly odd that if such a large percentage of the companies that are likely to be affected are US, that you'd expect there to be a net zero in allocation away from the US. And then in terms of implementation, you're right. I mean, it's hard to see how you get this anywhere without clearly legislation to make it operational. And over and above that, potentially you're going to have to deal with the treaty conundrum. most treaties have a rule in there regarding you're only liable to tax on profits allocable to a permanent establishment on arm's length principles. Well, if you're going to go away and write a bunch of rules that say we've got a new taxing right that's over and above permanent establishment, and we've got new allocation numbers that are over and above arm's length principle, you have to square that with treaty language somehow. Now, the OECD had experience of this with the previous round of a BEPS reports where they introduced a multilateral instrument. The one country that didn't sign up to the multilateral instrument, one leading country, was the US. And part of that was simply the process by which treaties are negotiated and ratified through the US requires, the Senate Finance Committee to sign off on those treaties, and that's not going to be easy to do with a multilateral instrument. So another challenge for the US specifically, along with everyone else, but for the US specifically.
Well, it's that second point. I mean, that seems like a really significant challenge, right? I mean, you can imagine with the Democrats in power, if they're going to try to do something through reconciliation, that, they could try to get some type of Pillar 1 legislation through that process. But the challenge of trying to get the treaties ratified seems to be even more challenging.
Yeah. And I think this is where I think the OECD and the US over the course of this year have, so the Biden administration Green Book made proposals in various areas, including in GILTI. Some of those changes in GILTI can be very much seen to try and make them more consistent with the OECD approach,
like the country by country
like
approach,
country by country, etc. Meanwhile, the Green Book suggests the repeal of FDII. It was informative to note that the OECD updated report on harmful tax practices came out last week, and in there for the US FDII regime, which had been potentially subject to review, was now removed from the list because it will be repealed in November. Well, Congress might be interested in the notion that it will be repealed. I mean, it's not up to the administration or the Treasury to repeal something. That's that's left with the Congress and Senate to decide. So
that seemed a bit presumptuous, and they
clearly
just kind of waved on the analysis of FDII that it's just going to go away. And you're right, the question is, well, if FDII doesn't go away, how is the OECD going to treat that regime?
Yeah, and the reality is for US multinationals, I think it's, you might be between a rock and a hard place, because at one level, the last thing US multinationals, I think, should want is for the rest of the world to believe that the US is not being compliant with the OECD proposals, because that gives them the ability to start applying things like the undertax payment rules. And I think that's a lot more painful for US multinationals than if maybe you get a GILTI regime that can be seen to be compliant with the OECD Pillar 2 proposal. So it's all a lot of politics at the moment. Clearly, on the US side, there's a desire, and the administration has not been shy to say it, along with Yellen, to say, we're trying to make our rules more consistent with the OECD so that the rest of the world will follow us and we'll all be in a good place because we'll all have consensus regimes. The danger of that is if you can't get the US system to follow that, the rest of the world believes that the US companies are somehow getting an advantage, and they start writing rules that potentially are worse for US multinationals.
Yeah, I guess, on the treaty point, because it's very interesting. I mean, I think you could make the argument, in fact, I think you've made the argument in the past, that there are certain provisions of our existing US law that are not arguably compliant with existing treaty. One that comes to mind is our foreign tax credit limitation, for example. So I guess one of the possibilities is that Congress could implement a Pillar 1 type rule and then just frankly ignore the treaties. And you just kind of move forward with domestic rules.
Which is largely what happened with BEAT. I mean, there are solid technical discussions to be had as to whether BEAT is in breach of the provisions of most standard US treaties. That hasn't been tested yet. The US Treasury position, I think, has largely been it's a after in time sort of provision. So BEAT was written, it trumps the treaties, but that's not clear that treaty partners will agree with that. And you're going to have exactly the same issue. I mean, again, the Green Book proposals, the Biden administration is to repeal BEAT, replace it with SHIELD. Well, SHIELD itself will have to be made somehow consistent with the treaties that are out there.
So let's turn to some of the challenges with Pillar 2. One of the obvious ones is that there are a number of jurisdictions with respect to this minimum tax at 15%. One of the obvious ones that has definitely gotten some press is Ireland at a 12.5% rate. Obviously, either that rate itself or even if they implemented some type of top-up tax regime, their rate is only 12.5. And there are a number of other countries, including Hungary, that's also in the EU. I think Estonia generally has a, that don't either have a corporate income tax or are significantly lower than that.
Right.
So talk a little bit about that and then some of the other challenges that you foresee with Pillar 2.
Well, I mean, I think the challenge for countries that are a lower rate, however that lower rate is defined, is, if the regimes are going to be put in place such that, if you're Ireland and you've got a profit being earned in Ireland and being taxed at 12.5%, someone else is going to impose a top-up tax on that to take it from 12.5 to 15.
Assuming it's not an Irish parent, is your point.
Assuming it's not an Irish person, but even if it's an Irish parent, they're probably going to apply an under-tax payment rule.
But could the undertax payment rule be more than the actual corporate tax?
Potentially. It's the denial of the deduction in the paying jurisdiction. So
fair enough.
So it's interesting to see how that works when they get to the mechanics. I mean, I think, the countries that are upset about it are upset about it at two levels. One is, the noise that it's a sovereign right of a jurisdiction to set tax policy by reference to the economic policy in which they're trying to encourage. And then the other is, well, am I going to be somehow damaged by this? And I think Ireland would look at this and say, well, there's a chance that some people who may have invested in Ireland to get to a beneficial rate of 12.5% may choose not to if they're just going to pay the tax somewhere else. But the gap between 12.5% and 15% isn't that big. Now, 15 isn't set in stone. There are a host of countries around the world who signed up to the inclusive framework but are saying that 15 is too low and they still want to negotiate that. Back to Pascal's comment of we just need to agree some numbers.
It's one of the few numbers to firm up.
Right. So 15 isn't set in stone. Countries like Hungary are at 9%. They haven't made so much about the rate differential. They've made more about the sovereign right. Countries like Estonia, which don't actually have a corporate tax on profits, it has a tax on distributions, saying, look, we'd have to completely rewrite our entire regime. This is, too far. So there's a whole range of views on this. I mean, there's no doubt the intention of the OECD minimum tax is that, to be a minimum tax. And so they are trying to actually write regimes which level the playing field for countries with vis-a-vis giving investment incentives. Now, what my view is that will likely happen is if the minimum tax proposals come in, countries that want to attract investments will look for other non-tax incentives. Right. So, job incentives, whatever it is. So, I don't think it's going to change the economic policy of a country like Ireland that's been pretty open for many years that its tax regime is set up to encourage investment in its jurisdiction, to create jobs and wealth, etc., etc. And they're not going to throw that policy out the window, even with a minimum tax regime.
Well, just like cities and states here in the U.S. that compete for investment dollars, countries compete for foreign direct investment.
Right, it's the same thing. And, at one level, FDII was no different from a federal perspective. I mean, FDII was meant to encourage investment and jobs in the US. Now, you can debate whether it did or it didn't, but that was its purpose.
Sure.
So we'll see.
One of the other challenges with Pillar 2, it seems, as you had mentioned, it talks about accounting profit.
Yeah.
And just timing and timing related issues.
Yeah.
And it just seems like a very challenging concept to be able to actually write rules as we think about some of the timing difference between tax and accounting profits, and then to the extent that some companies have cyclical businesses that end up within a loss and then income. Talk a little bit about that.
So yeah, one of the other minor things to be agreed in October is the timing conundrum. I mean, clearly the OECD has gone down a route of saying if we're going to apply minimum tax rules, we're going to do it from accounting profits. It would be too much of a burden and too difficult to do it on the basis of redoing tax calculations. Now that's a bit anathema to a US principle where everything's always done on US tax principles, and who cares about the book numbers? You have to go back and recalculate the tax numbers. But the OECD latched onto that very early on. Mm-hmm. That provides real challenges. I mean, you know, the current taxes and book taxes with deferred taxes, etc., are things that the OECD really don't understand that well. And when they looked at it and said, well, we need to deal with some sort of timing differences, and in the Pillar 2 blueprint that came out earlier this year, there were talks about, you know, credit carry forwards and loss carry forwards, and so the pushback largely on the public consultation was, why don't you just use deferred tax numbers that will properly reflect it? Now, of course, even with deferred tax numbers, you get things like valuation allowances you have to work through, et cetera, et cetera. So none of this is easy. And the OECD hasn't really solved that yet. That's part of the detailed mechanics that need to follow. But it is a precursor to some of the things the US is going to face as a challenge if the US goes to a country-by-country GILTI regime. Because, you know, whether people agree with it or not, the blending approach of GILTI allowed people to get comfortable that doing it on a period-by-period basis was okay because you got blending and that kind of smoothed the ups and downs a bit. And, you know, everyone sort of got comfortable with that. On a country-by-country basis, you can't do that. So, you know, you will get, you know, really strange results where if you do on an annual basis where, you know, you're setting up an operation in what is a high tax jurisdiction, you're going to make losses for a few years because you're setting up an operation. When you then start making money, you're going to pay top-up taxes unless you can find some way of giving temporal relief for the losses that have been incurred. And that's very difficult stuff to write. I think the US is going to face that struggle, you know, this fall on writing country-by-country rules for GILTI. Mm-hmm. We'll see where they go to with that. And I think the OECD have still got that entire struggle. They did not resolve it in the blueprint. They put up some ideas for consideration, none of which were perfect by any stretch of the imagination, and all of which were predicated on relatively simple examples. And as we know, life is rarely simple, so the facts will always be more complicated than assumed facts.
Right. I mean, the other example that I like to give is just if depreciation or amortization is different between two different jurisdictions' rules, you can imagine a situation where if you're allowed to, let's say, depreciate or write off something in a local country and you can't do it in the U.S., well, you're going to end up with GILTI, you know, actually U.S. tax income, but then you may not actually have any profits or any income in the local jurisdiction, so it's going to look like it's low tax when it's really not.
And the US has got that problem coming up, and with R&D capitalization, that's already baked into the US problems to be resolved. Even on a blended basis, that's having a significant impact. When you start going country by country, it's going to be a lot worse. So, whole host of issues to be resolved. I mean, I think the slight concern I've got is that the US has set itself up almost in timing to go first, and appears through the comments of, you know, Yellen and others to be setting itself up to be, quotes unquote, leading the way. And then the danger is one of two things. One is the US does lead the way and turns around and finds the rest of the world hasn't quite followed, or possibly worse is they can't get all these proposals through the Democrat caucus. They end up scaling back those proposals significantly, and the rest of the world says, well, the US isn't doing what it promised to do. We'll go back on our deal. We'll start looking at undertax payment rules. We'll start looking at other versions of Pillar 1, et cetera, et cetera. So I think that we're in a fairly delicate environment at the moment with, you know, lots happening on both sides, but it's not clear that those are going to be coordinated in consensus, and certainly the timing will be different.
Yeah, and your point on the U.S. piece is that the Dems are likely going to try to get something through reconciliation, presumably while they continue to control both houses of Congress, along with the executive branch, and query what they'll actually be able to do. And if they can't go as far, what does that mean for the overall? If they can't go as far as the OECD agrees and implement something consistent with Pillar 1 or Pillar 2, and we know that it's the thinnest majorities in the Senate, and we've already seen some pushback from the senators in Arizona and West Virginia, how far can they actually go?
Yeah, I mean, so far throughout the Pillar 2 discussion, US multinationals, I think, have been relatively comforted by the statements that say, GILTI will somehow be deemed to be a compliant regime with an income inclusion regime. And that's key for US multinationals, because in the absence of that, you've then got countries looking at the US system and saying, we don't think it's being taxed enough because you're cross-crediting from jurisdiction X to jurisdiction Y, because FDII doesn't have a nexus regime, because. And as soon as you start going down those routes, then countries will start thinking about writing rules that are definitely not preferable from a US multinational perspective.
So I think an important lesson, particularly for the U.S. MNCs, but also for the foreign parented groups, to engage in policy with policymakers, particularly here in the U.S., to make sure that those policymakers understand the implications beyond tax and what they have on job opportunities and their overall business. That these obviously tax policy changes can have significant impact on companies' businesses.
Yeah, and the hope would be that everything can work forward in a consensus way, and we'll end up with results. But we got a long way to go on both sides. I mean, obviously, the time frame for the US is significantly, in my mind, shorter than the time frame for the OECD. Whilst October for the OECD sounds very soon, it's not going to be a fully worked up set of proposals in October.
Well, as those developments happen, you'll hear about it on the Cross Border Tax Talks podcast. Calum, always a pleasure talking to you.
Okay. Thank you.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Calum Dewar, PwC's Integrated Global Structuring Leader. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.